Welcome to the Broken Pie Chart Podcast, episode 294. I'm your host, Eric Moore. With me once again is my semi-permanent co-host, although more regular than not lately, CEO of Zega Financial, Jay Pestrichelli.
Extra regular. I'd like to be extra regular, please.
That's what you said last week when I let you host for a couple minutes.
Extra regular.
Mm-hmm.
Yeah.
Okay. What is extra regular now, though, Jay, is another day, another all-time high in the S&P.
Wow. Right. That was quite the week again. Right. But look, I think there's a lot. We're coming up to what we're getting a little away from inflation, right? We had inflation data on Thursday and Friday, CPI, PPI. It was okay, right? Moving more towards labor market stuff. We had the Michigan numbers. And then now we're coming into earnings, right? So I think we're going to give the Fed a little bit of a break of the focus. And I think we could start to talk about earnings season. Finally, we could talk about something else versus, all the kind of macro interest impacting numbers. You know me, I always like to say two things drive the market: interest rates and corporate earnings. And if it's not one of those two things, if it doesn't impact one of those two things, take it out of the mix. So we get to talk about earnings now.
Well, this morning, of course, JP Morgan and Wells Fargo, I mean, both of them beat. 100% of the financials so far have beat. I don't know how many financials have actually reported.
It's early, right? We're on day 11, calendar day 11, right?
Yeah, but today really kicked it off in earnest, the names that will be out there. So earnings matter. If we looked at a chart, let's say going back to 1999, and it's the forward EPS per share on the S&P 500 charted against the chart of the S&P 500 index. Jay, no surprise. As earnings estimates go up on a per share basis, the market goes up too.
Yeah, I mean, this is pretty, it's highly correlated. I know we didn't run a correlation on this, but as earnings go up, as the 12-month forward earnings, I think that's important to say here, right? So as the 12-month forward earnings go up, so does the market seems to track against that. And that's, again, it's not surprising. It's a big driver of returns. I know we talk about, PE ratios and what's the value versus price of the market. But this right here, the earnings per share and the S&P 500, I mean, they are, I wish people could see this. It's like lockstep. There's a little bit of a wiggle, I'll call it, in like 2015, 16, 17. The market got ahead of itself and then earnings caught right back up. But yeah, this is I think it's fair to say there is a correlation between what companies make and the way the S&P prices.
I agree. And we just do an audio-only podcast. Although people have asked us to do video, there's more work involved with that. And sometimes we do these at different times and things like that.
A screen share, right? Just recorded the whole thing. Who knows? You do so much good work. By the way, compliments to you. You always do such good preparation work. And while I don't really get much time to review it ahead of time, we like it that way. I would tell you, they have these great visuals. I think, Derek, if you could only take this information and put it into a wonderful blog post, how great would that be? Could you imagine it's the visuals of the podcast? All you're doing is paste on what you pulled. I think that would be great.
Well, that's a fair ask, I think. All right, I'll put it on my list.
You did all the hard stuff.
I know. All right, so back to earnings. It matters.
Earnings. Okay.
And here's kind of an interesting thing. So far, and this is between what's come out already and what the expectations are for the current quarter, which is Q3 of 2024, in case anybody was wondering what year it is. The expectation is to grow year over year. So Q3 of 23, Q3 of 24 versus Q3 of 23. It's about 4.9%. Revenue growth of about 4% is what's expected, blended in with the actual companies.
I mean, that seems reasonable, right? 4%?
Well, it does seem reasonable, but here's the interesting thing. You look at, and this is from IBS and LSEG. This used to be somebody else. Maybe they merged with somebody. Okay, I'll find out who that is. But I get this email to me. And Jay, I mean, you look at Q4, Q1 of 25, Q2 of 20, you keep going out all these quarters. 12, plus 13.7, plus 13%, plus 16%, 15, 21, 18, going out all the way to the Q2 of 26. Good luck, nailing that one this far out.
Hold on. So as we're looking at this, we just, right now, this year-over-year change that's projected for Q3 2024, the quarter we're just in now, is saying, hey, you should have 4% growth in revenue, 4.9% growth in earnings. That's
Correct.
what it's next year. That seems fairly reasonable. You're telling me next quarter, Q4 of 2024 is a 12% projected, and the analysts are projecting
correct
12% growth in earnings, 12.2%. Then the next quarter, 13% year over year. Then another. So these are, this is kind of, this is kind of out of whack, right? I mean, these are big numbers.
Maybe they just think, look, there's more growth coming. There's more growth, and it looks like, based upon the, if you look at the net income is also projected to grow, revenue is projected to grow, but it looks like this is also, I'm doing the math in my head, margins are going to be strong. Jay, this is very bullish by analysts. I guess that's the quick take.
Yeah, no, this is strong. These are very strong projections for earnings in Q4 through, Q2 of 2026. I mean, who knows? That's a long ways away, right? But it's quite, these are impressive numbers if it happens. When I look back, there was one double-digit earnings growth? I guess Q3 of
Q3
was 10.1%, so barely double digits. This thing is riddled with double digits going forward. It's kind of amazing.
Q4 of 23 was plus 10.1%. So it's no wonder we're at all-time highs. We just talked about how, as the chart of the earnings per share estimates on the S&P grow, the forward, so does the market. No surprise. Here's where it gets a little crazy, and I got to be honest with you. I don't normally look at the Russell 2000. I mean, the Russell 2000 had negative year-over-year growth in earnings from Q1 in 23 through Q1 of 24. The actual last quarter, Q2, was plus 20.8. I mean, Jay, I can't even believe these are the numbers. Plus 41, plus 68, plus 38, plus 58, plus 49, plus 35, 27, plus 21. These are the sequential quarters all the way to Q2 estimate of 26. Those are massive.
Wow. Small caps poised to have remarkable growth. By the way, so for the small cap
investor, these are the estimates too. We should remind people these are estimates. Estimates can be wrong. Yes.
Jeez, even if they're like really wrong, this is still pretty big. These are pretty amazing numbers, right? To say, the estimate is up 68%, 40%, 38%, 58%. Those are large growth numbers. So this is the thing about the small cap investor, right? They know this. If you've been a small cap investor for a while, you know that you go through these periods where you fall out of favor, and then all of a sudden you're absolutely in favor. And so if you can digest the volatility of small caps, it's one of those things that you should outperform large caps over time, right? Historically, Russell 2000 over the long periods of time ends up outperforming the S&P 500. There's not a lot that does, right? The Qs do, Russell can. It all depends your time period. But this is really interesting time. I'm not saying buy the Russell today, but man, if you're a believer that earnings drives growth, then this is something you need to pay attention to.
You know what's striking too is, so again, you just reminded me again, the listeners can't see this, the multiple of the earnings growth versus the revenue growth. And so when I look at this, just to give an example, this current quarter is supposed to be plus 41.7% year over year growth from the quarter in 23 versus the quarter in 24. The revenue is only supposed to grow 1.4%. And the multiples are, I shouldn't say multiple, the ratio, because multiple means something else, meaning that earnings are growing on a percentage basis, are forecasted to grow much more than the revenue, what that tells me, Jay, is just without knowing anything else, and I'm not an analyst who follows the Russell 2000. There are other people who do that. What that tells me is two things. One is, they're looking at savings because rates are coming down. So these companies, a lot of them have debt. And the other thing is, I wonder if they're making some projections of cost savings from AI implementation in the businesses. I don't know that, but it is kind of striking that, it's not like, revenue grew 40% and earnings grew 40%. No. Earnings are growing over 40%, but revenue only 1.4%. That means their margins are going up, their costs are going down, they're being more efficient. I don't know, maybe.
I'm not sure. Like, take a look at Q1 of 2023, right? Mm-hmm. Revenue grew by 3%, but earnings dropped by 12%. Now, look, we were probably coming out of, a rough year of 2022. And there's probably bond and, debt stuff that's in there, but it doesn't always work that way where the revenue drives growth, right? So that's interesting that the revenue still had saw a negative impact on earnings. It's the small caps, right? You get this volatility in here. Maybe everything kind of just lines up. I don't know, Derek, how much of a stretch, how much AI has here. Like, I think about small caps, they're going to be slower to adopt AI because it's harder to make the investment, right, in the time. Like our companies, for example, we use AI a little bit, right, but it hasn't integrated its way in to our business that there's any kind of savings going on. We use it we'll put out a job description with AI. By the way, it writes a great job description. ChatGPT does a great job. So for those of you that saw any of our job postings, which we now don't have any, but if you saw them, that was AI written. We may use it for what? We don't use it for any of the content on the blog. You write all that.
Yes.
We don't use it for any of our pitch decks because that's all compliance reviewed. We don't use it to interpret any of the information sent to us. The only time we really use it in the investing process is if a company shows up on one of our screeners that we are interested in investing in. We may use AI to look for pending material legal suits or acquisitions, right? Because you may not find it searching for news. It may not pop out, right? So we would use it for that. But that doesn't make us, that's not really, that's a little efficiency there. But, so small companies may not really adopt AI very much. It may be a little longer. So I don't know. I would say maybe on AI, but I don't know what else is the rate. I'm going to say the leverage that they're creating from this little bit of growth. Is it lower debt? Is it, I don't know. Maybe they're maybe they're cutting their real estate costs because people are working from home. I don't know. There's a lot of stuff that could be here, Derek.
Oh, that's a good point too. Have they been? Yeah,
you're trying to get out of leases. It's been a while, and you realize, okay, I can get out of my, lease. It's run its course. I'm not going to renew for the same size. Big companies are making people come back to work. I haven't heard of a lot of small companies making people go back to work. Now, at Seika, we do have offices, but that's a different stamp. That's a different point. Yeah.
What year had earnings growth of 30% from memory?
No.
1995.
Why didn't I guess 1995? Why is that not here? No, that's a good. Again, echoes of 95.
We'll see what happens. I always remind what tends to happen historically is analysts come out with earnings that are higher, and then they get revised down the closer you come to that quarter or that year. We'll see what happens with these, but even as you said, even if they get revised down, they're still pretty robust.
If you're a fundamental investor and you like to look for strong earnings, you should be looking at earnings projections because these numbers are outer space. Like, they look very, very strong. So if that's your jam, take a look at those things.
The other argument against the market right now is that the multiple is too high. And let me see if I have an available screen on Bloomberg. What is EEO, right? Consensus. That's the function.
All right. I'll put it in while you're talking about it. So we use this all the time for.
So you want SPX index and then EEO. If that gets it.
That's it. You'll pull it up. You'll get it in a second.
Okay.
24.9, is that what it says, actual? So almost 25 price to earnings on the S&P right now. The forward 12, which is what we're talking about, is at 22.7. So, and then the forward year plus 1, plus 2, it's 20, and then 18. So look, there's definitely a disconnect here between the earnings that we're talking about here versus what this is looking at.
But this could grow. Yeah. I mean, the 1 year estimate is 20 and the 2 year estimate. Here's the thing. I mean, you can still get multiple expansion even at these levels. I don't know. I mean, so I always go back to if you were going to look.
But you don't need multiple expansion to have more growth, right? If earnings grow by 13% and you have no multiple expansion, right? The market is going to move 13%.
That's right. That's exactly right. Yeah. So you can get growth. The multiple stays the same, but earnings grow. And in theory, the market. Plus you have buybacks. So companies are buying back shares, which adds to and you have dividends. Like if you look at where the market is at X and where the market is at Y, it can be explained by either multiple expansion or contraction, earnings growth or not earnings growth, buybacks, and dividends. And that really tells you how your return was arrived at. So sure, if you were at 15 times forward, there's a better chance of having a greater multiple expansion from there. But multiples don't necessarily have to come down just because they're 22.74 forward 1 year right now. That would be an interesting, I'm going to write that down. We should do like the forward 6 month and 1 year returns by multiple.
Sounds super exciting.
All right. Well, I'll get right on that.
Kidding.
Fine.
All right. So look, earnings, look at it. Let's move on.
Yeah. And here's the thing. We buy, we hedge. That's one of the fundamental things we do. If you want to know more about that, shoot me an email, derek.moore@zegainvestments.com. That's DEREK.MOORE @Z as in zebra, E as in Eddie, G as in George, A as in Apple. It's up to you to spell investments correctly. All right. So let's, I want to talk about the Fed for a second. And, a lot's been made about, we're not quite at the 2% target. We're getting there. The 2% target, I believe, started in January of 12. I think that's when the Fed sort of adopted this target. So I went back and I looked since on a monthly basis. So every month when CPI comes out, we have the year-over-year level, meaning what's inflation, the CPI index today versus a year ago, and you have the change. I said, how often, and I gave him a break, I said, how often has the year-over-year monthly change in CPI been between 1 3/4 and 2 1/4? And it's 17%. Only 17% of the time.
17% of the time, it's in their target range.
Correct.
Not great.
Well, especially considering through that time, it's been greater than 4%, the exact same time as around their target, also about 17%.
But do you think it's hard to pin inflation on the Fed, right?
They had nothing to do with it this time. No,
it's hard to
zero.
blame them.
It's the politicians.
And
I got an idea. Let's send out trillions of dollars to people when there's a supply chain problem and just pour gasoline on the fire. How's that going to work? No,
well,
didn't work out.
We know what happened in 22, right? We saw the result of that. So look, but their job is to manage monetary stability in the middle of all that nonsense, right? So it's a hard job, right? Like you're trying to manage this, you are trying to manage stability in an environment that can be all over the place, and you have no ability to impact the inputs of that. You just can be reactionary to the output. So I don't know. I'm glad I'm not, on the Fed.
Yeah. You and I and our listeners can go back and pull the old episodes. I think before they started raising rates and inflation was around 9% year over year, I believe you and I even said that if they could raise rates, but it's not going to do anything. Like if inflation goes down, it's not because of that. We were talking about this exact thing when inflation was really high. They didn't cause it. And we'll never know. It's just like in 2008, 2009. If they didn't bail out the banks, what would have happened? If the Fed did nothing, what would have happened? It's an unanswerable question, but anyway.
Look, this is the thing. I think the Fed has the ability to impact the way investors feel, how scared or safe they feel about the financial markets. I think there's an emotional component to the markets. We all know this. And I think they have the ability to, help ease concerns and fears. And that ends up helping, investor sentiment. That helps investor behavior. And, sometimes the market is like anything. It is what somebody's willing to pay for it, right? By the way, I'm not going to go down the Bitcoin path for you, although I feel like you may think I am.
Oh, I have it in our recommendations this week. Wait for it.
It's going to be fun to talk about.
Yeah.
But my point is, like, if people believe in the markets can be more stable. If they don't, they aren't, right? So it's just one of those things. I think that is one of the biggest impacts they could have in those periods of raising rates or lowering emergency reduction of rates to save the banking system or bail out an economy, right? Look, there is no doubt that when the Fed cut rates in 2020, it spurred this humongous real estate boom, right? Because what was going on in the world at that time, and people wanted to move out of cities and all those kinds of things, but they made it so much easier. I'm not sure that we'll ever see 2.5% interest rates again on a mortgage. I'm not sure we'll ever see that again, right? But like that was the environment we were in, and it spurred all this investment and got people to think longer term versus what was happening to, the little restaurant down the street that couldn't, serve you food anymore because you had to wear masks and sit 6 feet apart, right? Like it was, I just think there's that different emotional impact that it can have on the longer term aspect of investing, which drives stability in the markets. That's where I'm going to go, right? Because you don't know, like you said, you can't tell what the impact really is if they didn't do what they had done. We shall see. We certainly know they caused all kinds of fear in the market for 2022. But again, that was all self-inflicted. We didn't have to do those things. And I think you and I would both agree they didn't really have much of an impact to inflation on the activities that they probably hurt, the housing cost a little bit.
But if you're the Fed, if you're any of these people, like I saw, I don't think you were there, but I went to, it was a Schwab Impact. When was that? It was probably 2014, 2015. I remember it was in Denver. George W. Bush spoke. And then the next night, Ben Bernanke spoke. And to hear Bernanke talk about, looking back at the 2008, 2009. And I think one of the things, they're tasked with doing stuff. People look at them and it's like, okay, we got to try stuff. And if you're on the Fed, you can't just sit there and be like, no, we're good. Like, you have to go before Congress. What are you doing? Nothing.
Right.
No, it's good. So, what is it? When all you have is a hammer, everything looks like a nail. So
you can either talk about hammering or hammer.
That's right.
That's all
That's
I got.
Right. This isn't on our list this week, but the market didn't like the hotter than expected CPI. And I don't want to get into too much of the CPI. It was 0.3% month over month compared with an expectation of 0.2. Jay, was it the level or was it the fact that it came in hotter than expected? Like if the analysts had done a better job knowing that, I don't know, whatever moved, I think it was medical costs. I'm looking at the list now, medical costs were up and transportation was up. I'd have to dig into that to see what part of that. Was it if the analyst would have said 0.3 and it came in 0.3, would it have been fine? I don't know.
No, I don't think so. I think. Yeah. Look, there's this number, right, that we're trying to say things are kind of going on target, and the Fed can feel comfortable to lower, right? And then people like it when the Fed lowers. I don't think so, Derek. I think I don't think it's and I think the actual number was the problem, right? I think it was actually, hey, it doesn't have a 2 handle. I don't like it. I mean, I think was my gut feel.
And 0.3% month over month, if you compound that over 12 months, what is that, like 3.7%?
3.738, yep.
Yeah,
yep.
versus 0.2.
It's not the target.
Well, either is 0.2. 0.2 would be about 2.5% or 2.4%.
But at least it's close. Like it still doesn't fall into your range, your 1.75 to 2.2.
17% of the time, they're within target 100% of the time. 17% of the time, it works 100% of the time. Right? So I don't know. All right. I don't really want to I'm bored with the inflation stuff. Let's talk VIX. And you and I were on this a couple weeks ago, and we each independently, I knew we sort of talked about looking at this, but independently, we took a look at some of the VIX data. And, the VIX right now, market's at an all-time high. What did the VIX close today? It was above 20, right?
It was above 20. The last, I got a 20.46. The low of the day was still above 20, 20.14. So a 20 handle on the VIX.
So I just thought it was odd, but I didn't know if it was odd. And I went back and I looked at the chart and I said, last week we said, March of 2000, it was high. You did some analysis. I'll let you go first.
Okay, so I took a look and said, all right, so when the market's been at an all-time high and the VIX has been at 19, I just put 19 in because I think we talked about it last week.
19 or higher, right?
19 or higher.
Yes.
Yeah, and when, you take a look at that information and you say, what happened over the next 60 days? Why did I pick 60 days? I feel like that is kind of the range of what the VIX is looking at, right? The way that the calculation is supposed to be a 30-day number, but there's data from multiple expirations, near term, farther term. So I looked at 60 days out. And when you look at 60 days out against the VIX, the performance when the market is high, all-time high, and a 19 or higher, it's actually not that concerning, right? There's plenty of instances here where the market continued to go up. And actually, if you can get over 21, it's even better. I didn't run the averages here because I don't want to skew anything. VIX at 19 to 20, it's kind of an even mix. Up 10%, down 10%. You have a little even scatter plot here. Maybe a little few more times it's up than down. But if that VIX is even higher, strangely enough, Derek, and people think about the VIX as a fear index, it's not, it's more of a premium index. As you get above that 21, 22, 23 range, all of a sudden there are no instances, and this doesn't mean it's what's going to happen, but no instances where the market's corrected down 10%, very few at even minus 5%, but a lot of instances where the 60 days later at an all-time high when the VIX is over 20 or 21, you've got a lot of instances where the market is up 5 to 10% just over the next 2 months. So I would tell you this was not the reaction. It was not the results I was looking for. So I was a little surprised when I saw that, right around where we are with the 20, it's kind of a mix, could be up, could be down, maybe lean a little bullish. But if we actually see a higher increase in the volatility index, while we're at all-time highs, it's actually a bullish signal if history repeats itself.
I did a little bit differently. I did an XY scatter plot. And so you have all the dots, and I think I had the y-axis was the VIX, and the x-axis was S&P change 6 months later, and the change a year later. And really, with the statisticians out there will know what R squared is. The R squared is very, very low. I mean, you can't really draw a conclusion. But looking at the scatter plot, same thing. It's like more of the dots are, 20 and higher. Most of the dots are to the right side of zero, meaning it's positive. And same thing on, the 12 month. And you'd also say this, I won't explain what R squared is, but basically you're looking at this. You can't deduce from this chart to say, oh, every time VIX is high, I know that at all-time highs, I know a year later or 6 months later, it's going to be down. Like, it's all over the place. It's
all over the place. And so the VIX is the contrarian indicator is definitely not a solid thesis. It may not be. It doesn't tell you much a year later.
Not in this case. And both of us, I think we looked, I went all the way to January 1st of 94. I think you went back to 93, right? Which is when the VIX started. I guess
I think the VIX is at 90, but I was using SPY data instead of S&P data, but yes.
Okay. Yeah. They should be the same.
Yeah.
Relatively the same. So, yeah. And then, I also looked, so just to throw a little color on this, I went and I looked and I said, well, when were the periods when the VIX was really high at all-time highs? No surprise, towards the end of 2020, when you had the hangover from the COVID period. Oh, I'm going to get the check mark.
You said it. You did it.
We're going to get the message, the disclaimer.
Do they still do that? It's 2024, dude. Really?
I don't know. We'll see.
Well, listen, we know Elon wouldn't censor you.
Yeah. Twitter doesn't do podcasts, though. I'd put it there if it was there. All right. So, yeah, August of 2020, all-time high, 21.5 VIX. 26.5 VIX in September of 2020 at an all-time high. Like, we kept making all-time highs. Even
going into an election again.
That's right, going into the election. Then you go back and you say, okay, well, that's fine. That's a special period. And, that doesn't make sense. 98 and 99, VIX above 20, all-time highs. Now, there was the Asian contagion, emerging markets, a bunch of stuff, but still, it's like I'm looking at some of these. The VIX is, 23.86, 6 months later, plus 19% S&P. March of 2000 is the one where it was high, it was above 20. So, yeah, I mean, here's what I would think too. I follow the Move Index, which is sort of the VIX for bonds. And I think the Move Index has been really high of late, or it's spiked recently. And we've had this sort of sea change right now with the Fed. Will they raise? I mean, will they cut? How much? The curve is changing. I think it's the volatility in the bond market, and the VIX is reacting to that. I don't know that the VIX is actually saying it's fearful of what's going on in the stock market. Could be wrong, though. What do you think, Jay?
I think no. I disagree. So
fair enough.
Look, do I think that the bond market can drive equity volatility? Maybe. We certainly have seen that in the past, but I think it's got its own volatility drivers. Obviously, we've talked about this, that, as we're in this rate changing environment, lower changing environment, we don't know how much it's going to change, report by report. I mean, I remember on the last Fed meeting, you said, hey, this is the first time I've seen, a few weeks ago, when we talked about this, first time you've seen going into the Fed meeting that the bond market didn't know what was going to happen, right? Remember, it was like 60%, 35%, right. 65, 35. Bond market didn't know. That in and of itself is going to drive its own volatility. I don't think that that is driving equity volatility, right? I think there's other things driving equity volatility. Obviously, this election is a big deal. What's going on in, we could name all the things that cause market volatility. A lot of them are kind of persistent and don't necessarily get reflected in the VIX. But again, I think you and I question a little bit, like, why is the VIX where it is? If you want to point to the bond market, I said, I don't think that tail is wagging the dog here. I know there's some correlation, do not get me wrong, but I think it's for different reasons. I would say don't confuse correlation for coincidence.
I don't know. I mean, lately, I think in 2024, if you look at the shape of the move index chart and the shape of the VIX index chart, they are very similar. That's all I'm saying.
Both reacting to the Fed, right? I would say, Fed, wish you could overlay something else that showed, the propensity for the Fed to cut. We know Fed cutting, right? You don't fight the Fed, generally bullish for the markets. Fed cutting changes interest rates, adds volatility, right? So the Fed is kind of impacting both of these. I don't think it's the other. I don't think where one of these is impacting the other. By the way, I don't think the equity volatility is affecting the move index either. I don't think because stocks are moving around, bonds move, they march to their own drum, right? We know this. They don't have to necessarily be tied to what's going on in the equity markets. No. Yes, there is the flight to safety fear, trade where people dump equities and roll into treasuries when things are really fearful. But besides that, these days, the two of those, I think they have some separation.
I predict over the next 1 or 2 weeks, if you watch CNBC, they're going to be talking about the VIX Index and the stuff we've been talking about the last couple of weeks, how the VIX is high at all-time highs. I think it's going to start to be part of the conversation because I've already seen some bad-looking charts on Twitter.
Yeah, it should be part of the conversation. We have this scenario that's uncommon happening, but not as uncommon as you and I both thought. Turns out it happens. It's okay.
It does happen.
And it's in and of itself, it's not an ominous sign, right? It's not I can't remember the word that I'm thinking of, but it is Halloween season. So I'm sure there's some pending doom term that we could talk about. It is not that, right? There's been plenty of times. Like you said, look at the last election. We had a high VIX in September of 2020. Market moved higher. Things were okay. So you got
next meeting is November 7th. Looking at the probability for a rate cut, one rate cut now is 88%, not 100%.
Yeah, still just one. Well, that CPI must have changed that because I think it was 70% earlier in the week. So CPI coming in higher probably made it less likely to do 2 cuts. Which that's what it seems like it looks.
That changed with the employment, though. Wasn't it the employment? It was the unemployment rate.
Oh, yeah. The employment number was great on we talked about it last week, right? So
because that's their excuse. Oh, softening labor market. That's why we have to. Because if they just tried to point to inflation, they're not a target yet. And one of the governors, I would love Powell at the next presser to be like, look, we only get there about 17% of the time. So if you guys are waiting for that, good luck.
Right.
You're going to be waiting for a while.
Yeah.
All right.
So can I just sum that up a little bit? Like I feel we're going to need a counterpoint here, Derek, and you're always good about finding the counterpoints here. So we're talking about a rate environment of lowering. We don't know how fast they're going to lower, but rates coming down, bullish for the market. You've got this period, and this is something we talked about 2 weeks ago, 1 year after the Fed starts a rate cutting cycle, the market has historically always been higher, sometimes single digits, many times double digits. Okay, so we're in that phase of things. You've got, we've got this election cycles. After elections, markets can go up. You've got earnings at this growth rate, which today, as you brought into the mix, double digits, right? Year-over-year earnings growth. Like and we just determined what I was hoping that VIX would be the data that you and I both took up on our own to go research, that data would give us some pause that, when the VIX is high and the market's at an all-time high, things are bad. Turns out that's not the case. Turns out it actually leans a little bullish. Like why should you not be all in at this point? Like why are we not, rolling our, taking our hedges and just, hey, let's lock this in and let this market roll? Like, what is it? Like, what's the counterpoint?
It's it's the unknown unknown. Wasn't that Rumsfeld who said something like that? The known unknowns or the unknown unknowns? Like, you never know when something's going to come out of left field. Like the Japanese yen,
the carry trade scenario.
The carry trade. Like, 3 people probably had that on their bingo card. But the other thing is, we talk about this like everybody's going in and out of the market. And I'll just, we have clients who are different ages, different points of their life, different goals. And so, that's why you don't just say, well, I'm going to not hedge. Number one is hedging tends to be fairly cheap. And we've been talking about the 30-day volatility. Further out volatility, like a year out, isn't necessarily reflecting what we're seeing in the near term. But it's people's circumstances are different. If you're retired or nearing retirement, got a good base of money, why wouldn't you hedge? It's relatively cheap. Go ahead and hedge. Stay in the market.
Just
market keeps going up. Great.
Right.
Keep doing it. Do what you're doing.
This is like, there's a lot, I don't know, a lot of tailwinds here, like the unknown. Again, like we've talked about things like, is there...
All right, here it is, Jay. The escalation, it escalates more in the Middle East and it bleeds into oil prices. We know if oil prices spike, that is a problem for the economy. There's a correlation there. You get oil above 120 or 130 or, all that's like, all right, so that's sort of a known unknown. That's a big thing. If inflation comes back, maybe this was a little hot. Maybe it runs 0.3% and we go, we're gliding towards 3.5% year over year again. Like what if the earnings come in much less than expected?
Yeah, so we're going to have to get a surprise here. Like maybe this market is just, it's priced to perfection, right? Those numbers, by the way, while we're looking at them, isn't the first time a lot of people that use that data have seen them. They've seen it before.
Yeah.
So, right, we start getting earnings misses and that falls short. There you go.
Well, it could just be a multiple lower. Yeah, multiple contraction.
We have seen multiple contractions before during periods of earnings expansion. That's happened.
Yep.
Yeah.
So,
all right. Look, I'm trying to paint the other side of this thing, but I love the way that we can just have the ongoing exposure, roll your hedges, lock in what you've got so far this year, move that protection level up, and then stay long in this market and let it run.
At the end of 2021, if we were on the podcast, and you can go back and listen to our episodes, sometimes people do that. They'll download like 284 of them. And we were probably talking about the same thing. Yeah, just stay in the market, be hedged. The multiple is high, the sales, price to sales was high, all that sort of stuff. But here's the thing. Like, people talk about that stuff all the time. There have been bears for the last 2 years who are throwing stuff out there saying you should sell everything and go away. A crash is coming. You don't know. You just don't know.
Don't know.
Yeah.
All right.
All right. That's, I think we beat this up enough. I got to talk about Satoshi and Bitcoin. I'm sorry.
Sure. What do you want to talk about?
Have you seen the HBO documentary?
No.
Okay. I did.
All right. Did it make you a believer?
Well, it was called Money Electric, the Bitcoin Mystery. And the documentary filmmakers are trying to figure out who Satoshi is. And I think they arrived at this guy, I was going to say Richard Todd. Richard Todd's a former quarterback for the Jets. Jeff Todd? I'm looking it up right now. But yeah, they presented some evidence that there's a sphere of people. There's probably 4 or 5 different people. And one of them could be Satoshi. But the interesting thing is, and I was going to ask you about this, they say that his 1 million Bitcoins haven't been touched. So they're just still there. And they were asking like, oh, what if Bitcoin went to 1 million, he'd be a trillionaire. He or she. We don't know who it is. But it was a search for Satoshi.
Oh, I will definitely watch it. Yeah, look, that's something that could flood the market too, right? But you got this supply-demand dynamic. I keep seeing in my social media feed the Warren Buffett. I'm going to take the other side of this for you. The Warren Buffett kind of interview where he says, if you're going to, ask me to write a check for 1% of all the farmland for America for $25 billion, I'm going to write you that check tomorrow because that farmland is producing something. If you asked me to write you a check for all of the Bitcoin in the world, I wouldn't even pay $25, but because it doesn't, $25, not 25 billion, $25, because it doesn't do anything. I'd have to sell it back to you. I can't do anything with it. That's not an asset that grows. So I thought that was an interest. I don't know why. I don't know somehow if you're figuring out a way to change my my social media feeds to see videos like that. But I feel like it is always an interesting point, the two sides of the Bitcoin discussion. As gold is hitting new highs, it always seems to come up as well. Bitcoin had a particularly strong day today, I believe, right up 5-something%, almost 6. So you look, sometimes this thing goes up, sometimes it goes down. It's a trading vehicle. I do like the storage of value, and it's like owning a building. It's what somebody will pay you for it. But I don't know if I need to know who Satoshi is.
I still think, all right, so this is me not completely understanding it, but I'm like, okay, let me start a currency. It's not a currency, by the way, but let me start a quasi currency, and I already start with, I've got 1 million I got 1 million tickets already.
I would start with 1 million. That's a good number.
Yeah. Well, apparently that's what Satoshi has in his wallet. So it's like, wait a second, you're going to start this thing and you're going to say you have it already and you didn't pay anything for it?
It's amazing.
Sounds like a scam to me.
Let me ask you a question. When you started your business, did you have anything in it? You just started it and it ended up having value, right? Maybe that's okay.
It's a scam. Come on.
I'm not going down the scam. Don't come on me with the scam. It's not.
It was interesting with. I didn't understand about I guess they call it a fork, or the two different camps. One were the Bitcoin maximalists, where they wanted to increase the block size for more transactions, and the other ones who had to keep the block size the way it is. It would take 10 years to make it easier to do transactions, and of that group is the one where they claim one of those guys is Satoshi.
Okay.
All right. Well, I mean, it's pretty interesting. I thought it was boring, but it was interesting. How's
All right. That? Okay. Right. So not a strong recommendation, but if you're curious about this, then you can watch it. I
mean,
sounds like there's no big reveal. Maybe it's this guy.
It was interesting, and they showed how this one group, they go to different countries. They try to get people to adopt it. So they went to El Salvador. They went to these different places. I was entertained by it. What I really liked, it wasn't a series. Just, all right, fine. I'll give you an hour and a half. Great.
There you go.
I'm not locked in for, 30 episodes for 7 seasons. It's like crazy. All right, what do you got?
Well, we always talk about Netflix shows. Netflix has earnings next week, I believe, right? I think earnings are coming up maybe in 2 weeks. So can I talk about Netflix for a second, right?
They are Thursday, next Thursday after the close. Okay.
So, have you looked at a chart of Netflix? Have you looked? Right? A year ago, trading at $375. Today, closed at $722. Mm-hmm. It feels like, everyone kind of kicked it out of FANG. FANG can't matter anymore. It's about the Magnificent Seven. The stock has had quite the run, I think, right? If that's
up over 100%.
Yeah, that's not bad. I don't think that's bad at all. Look at the volatility for the earnings kind of coming up here, 60%, 70% vol, right? So options are projecting an interesting move here. The straddle, which is what we look at, that's the cost of the call and the cost of the put. If you put them together, what's the break even that it would have to move? It's got a $58 move in it. So, that's a decent amount of a move as well. I think it's, it's at 10%, 6%, 7%, 8%. So I don't know. It's just interesting to watch that one. That's something we'll be keeping an eye on this week coming up. If you're a seller of options, there's juice in Netflix this week that there normally isn't. It's probably because of the earnings, right? So it's one of those things to keep an eye on.
Taking a look next week, Tuesday morning before the open is United Healthcare, ASML, Morgan Stanley. On Wednesday before the market, TSMC. ASML is a Dutch semi. Taiwan Semi, TSMC. Thursday before the open.
So we get some semis in there. That's great.
Yeah, you start to get that. But yeah, I mean, Monday, like Schwab, Bank of America, Citi, more of the financials. I'm looking at the board here.
I'm going to look at UNH. So I'm just going to look at the 1 week options on UNH. Trading
there you go.
600. Let's say it's 598. Let's say it's rounded to 600. The IV on that. So the implied volatility on that, right? The move on that is only $30, right? So that's not a huge move that's getting implied in there, right? 5% move up or down on a stock that, I think, this is one of those stocks that we have traded for some individual clients. It's kind of poking up against those highs, but it's not a smooth chart, right? I mean,
no,
right. It was at, 550 back at the beginning of the year, then it dropped down to 430, and then it had this, little spike up that happened in July, and then it's kind of been like, slow trend upward. It's one of the, it's not it's not smooth, right? It's a little spastic on the movement here, but always around earnings, there's always interesting stuff on United Health. That's one that, we only trade it for that individual client. It's not one of the funds that we trade, but it's always an interesting stock because it's such a big component of healthcare, and just healthcare has this kind of bullish feeling behind it for the next, decade, right? With what's coming down the pipe with healthcare needs. So interesting stuff there with UNH.
I wonder if, and UNH too, I don't have the official, I haven't done any work on this, but I feel like it's a coin flip, whether it moves up or down after earnings, but I feel like it normally moves.
It can definitely move. So this might be one of those cases, Derek, right, where we would say the implied move, you're not getting paid for the implied move. If you're a seller of options, might be one you want to buy, right? In those scenarios, you could either say, where's my break even on this? If you bought, kind of that right at the money, you're looking for a 30-point move. So 630 on the upside to 570 on the downside. Those are the kind of moves you could look for.
It's a 5% move. Yeah,
that's the 5% move that's in there. If it could have a bigger move than 5%, has it had moves bigger than 5% in the past? Well, we could take a look, right? So if you look at earnings from, what was this earnings? Back on, I guess it would be July 15th, right? It didn't move very much. It had the big move going into earnings, right? So it stayed sideways for a while. Same thing if you go take a look at April, right? The April 15th move. Yeah, okay, it moved up from 440. A week later, it was 500. That's a good move, right? That's more than a 10% move. So it's a spotty one to trade when it comes to the options. It's not really obvious. I know we have some listeners that trade based on earnings alone. You guys know who you are. This is the tough one. Sometimes it's not clear that there's a lot of movement. Whereas you look at like a Netflix, there's always some kind of a decent movement. It's just the magnitude. You just don't know. But sometimes with UNH, you end up getting this flat move and no impact at all because it moved ahead of time. We'll see. This one, it hasn't moved all that much ahead of time.
So you're saying Netflix, because they stopped, 1Password, 10 people using 1Password, that worked, and doing the ad-based version?
I mean, if that is the driver of growth, then yeah. I mean, it's a pretty channel up and to the right. Like if you're looking for bullish stock, that's what you want it to look like, or at least you want it to happen after you buy it.
I think they should lease out their operational know-how to the other streamers, because the experience on like the stuff that's on Netflix isn't as good as stuff that's on the other ones right now, in my opinion. But the watching experience is so much better. Like the sound always works. Finding where you were last, finding stuff, just one show.
You like the interface, right? You like
the interface. It's so much better.
So they got better UX, folks. User experience, folks.
Yeah, like Apple TV Plus. And by the way, I finally watched the end of Bad Monkey. Every time I turn that on, I got to unplug the soundbar and plug it back in for Apple TV. So not only do they make me wait a week to watch. I mean, I started watching the show in October. I'm like, come on, let's just go. Just give me all the episodes. So
you're done with it? What'd you think?
I liked it. I would have liked it all in one sitting.
I was, again, disappointed at the end. I thought it was fine. Look, Vince Vaughn does a great job. He's entertaining every time he's talking. It's hilarious, right? But really? They're going to end it that way?
I know. Well, it reminds me of Game of Thrones, where the best episode was not the last one. The Long Night, where the Night King Arya kills the Night King. Sorry if you haven't watched it.
Wait, Arya kills the Night King? And one of the coolest scenes. I think it's great the way she does it too.
Yeah, that was phenomenal. Yeah. That was absolutely phenomenal. But then the final episode, I don't even remember much about the final episode. It wasn't good. It was not good.
Khaleesi, not great. Not good for her.
Have you seen on YouTube, there are the Long Night and the scene where Arya kills the Night King, there are crowd reactions. So it was playing in like a big bar or at a restaurant, and they show the crowd just going nuts.
Everybody goes nuts.
Yeah. Yeah.
She was a fan favorite. But anyway, not a fan favorite the way Bad Monkey ended. It was fine. Just come on, really? Listen, I didn't need the fairy tale ending.
It was rushed. No, it was rushed. It's like you spent all this time setting it up, and then really? That's what happens?
Dragon Queen story? I didn't even connect the dots there. What was the point of all that? In all of it, maybe because all right. I won't.
Yeah, don't give it away. It's still new. If you haven't watched Game of Thrones, sorry.
Yeah. If you haven't watched, you deserve that one. By the way, it's one to watch. If you haven't watched, don't watch it. Don't watch it with the kids.
That's right. I love that because you watch that every week week after week, and you always say you got to watch it. I'm like, yeah, whatever. I think I finally watched it before the final season. So
you got through 7. Yeah.
So I watched every season, I did it over one December, and it was great. And then I had to wait for the new season. I'm like, oh, okay. You guys really had to, like, the season finale, and it's like, oh, do you want to watch the next one? I'm like, I think I will. And poor you guys who watched it in real time. You had to wait like 6 months.
And then they said, no, forget 6 months. They started extending. It was a year. It was a year plus. And then they'd only give you like the last 2 seasons, like, you got 6 episodes. You got 7 episodes. You didn't get 10. So whatever. I can be mad at HBO. It doesn't matter.
Okay. Mad at HBO, watching Netflix earnings, United's earnings, and we'll watch the VIX. I think we got it covered, Jay.
You do, all right. That sounds good. I wish I had another good recommendation for you. You know what I'm watching? Through 2 seconds, I'm watching The Irrational on Peacock. Not bad. New season's going to come out soon. It's kind of fun. If you're a behavioral scientist person, if you like behavior science, not bad to watch it. The Irrational.
The Irrational.
It has to do with a college professor that studies human behavior, and he gets pulled into all these kind of interesting crime scenes. So he's not a police officer, but he kind of consults, and somehow he's able to go and interview criminals and stuff. It's not realistic, but it's entertaining when they talk about the different behavioral patterns and irrational studies and stuff like that.
Peacock is a bad interface. And I don't know what it is, but like I tried to watch it and it's like, oh, your password's not right. I'm like, I just gave up.
Peacock's a bad interface. I would agree. Agree. It feels like the jalopy of streaming interfaces.
Oh, my wife must be watching this. I've walked by and she's watching this. Okay.
Speaking of jalopies, we had a listener who took a Waymo in Scottsdale. Said he had a great experience.
Yeah, I haven't done it yet. I'm going to do it.
All right, you say you're going to do it. John did it. He sent me a note. Said it was great.
My wife, she was out with her sister-in-law, and they tried to take a Waymo a couple weeks ago, and it said it wouldn't go to our house.
Well, because it knows you don't like him. You don't trust it. It's dispositioned.
Well,
speaking of robotaxis, not. By the way, not a great reaction to Tesla from their robotaxi big presentation.
My understanding is they want to try and do everything with, is it a single camera or 2 cameras? And Waymo is using, radar and LiDAR and cameras and a bunch of stuff. I think is that the disconnect with the Tesla one?
I don't know. The market just didn't like it. Down 8%, over 8% today after they had their robo taxi, big presentation Thursday night. Market did not like it all that much. Everything else in our portfolio looked pretty good today. Tesla, not so great.
Not so great.
Not so great.
Well, I can't take a robo Tesla yet. So
No, you can't. Although it looks like he took one. It looked slick, like everything he does looks slick. I hope he gets it right.
Isn't his vision though that you could buy one of these and then immediately, like it's in your driveway and you're like, okay, let me hit the app and go make money for me.
Yeah, it could either do that or it could take you to work and you could read or listen to wonderful podcasts or read and listen to a wonderful podcast. I don't know. But yeah, that's his vision. And maybe not everybody needs to have a car at the same time, right? So
it would be nice. You ever you remember in New York, you'd get in and the guy would be like screaming into his phone. Like, I don't know who they were yelling at, but they'd always be like having an argument while they're driving the cab. Like, it'd be nice to get in a car and not have to interact with the driver.
Last time you were in New York, yes, they still yell on the phone.
They still yell on the phone?
The Uber drivers don't so much, right? Although, we all get the Uber driver gets a phone call from somebody, who's talking the whole time that he's driving you, which I guess that's cool. I don't care. I don't want to talk to him anyway. I'm not the guy that needs conversation.
No, but that's what I mean. Like, you get in sometimes, you're like, oh, where are you going? What are you doing?
Nope.
I'm like,
sorry.
In the early days with Lyft, I took a Lyft and I used to get in the front seat and they would high five you and they had the mustache in the front of the car.
Like a pink mustache?
No, it was a black mustache.
Oh, was it black?
I don't know. Was it pink? Might have been pink.
I don't know. Could have been one of those. Yeah. No.
But it was, I remember I got in and she's like, okay, high five. No, get in the front seat. High five. And I'm like, all right, we're doing this. All right.
It's weird.
All right. That's it.
Okay.
All right. We'll be back next week and we'll see what we said that was right, what we said that was wrong. And we won't take credit for any of the things that are wrong, only the things that are right. See you, everyone.
Bye.
Bye.